All right, today on Talk Tickers, we are diving into the Q2 2025 earnings call for Tsakos Energy Navigation. That's ticker TEN. Now, on the surface, this was a fantastic quarter, but the way the market reacted, well, that tells a completely different and, honestly, a pretty confusing story. So let's get into it.
So first up, let's just look at the headline numbers. TEN delivered earnings of 67 cents per share. That's a clean beat over the 60 cents Wall Street was expecting. And revenue? They absolutely crushed it, pulling in over $193 million when the forecast was only around $156 million. I mean, that's a solid beat on both the top and the bottom line. So with a report card like that, you'd think the stock would pop, right? Well, not quite. The stock actually closed the day down 3.4%. And that, right there, is the big mystery we're unpacking today. Why in the world did a strong earnings report lead to a sell-off? To solve this puzzle, you first have to understand the story that management is telling. On their call, they laid out this really bullish long-term vision. They're basically arguing that they're building a predictable money-making machine, and they're not just chasing results from one quarter to the next. And at the absolute center of their argument is this number, $3.7 billion. That's their minimum contracted forward revenue. Now, this isn't some guess or a projection. It's business that's already locked in. This gives them incredible visibility into future earnings and acts as a huge buffer against the choppy, unpredictable tanker market. And you could really hear that confidence in their tone. They know things are kind of crazy out there with all the geopolitical stuff happening, but they made it very clear that they've been able to navigate through it all. The message was simple. We're in a great spot, and we feel really good about what's ahead. This confidence isn't just talk. It's backed by a clear strategy they call capital recycling. It's actually a pretty straightforward three-step plan. Step 1, sell your older ships for a nice chunk of cash. Step 2, get your new ships locked into long-term contracts. And Step 3, take that cash and invest it in a modern, eco-friendly fleet, like the 3 brand-new supertankers they just ordered. It's a smart plan to keep the fleet young and the revenue locked in. Okay, so the management story sounds pretty solid, right? So where is this disconnect coming from? To figure that out, we have to do a little detective work. We've got to read between the lines of the financial data and look for clues in the Q&A with the analysts. And this table right here is the biggest clue. Now, while fleet utilization was up, which is great, you can see that both revenue and net income were actually down compared to this time last year. But here's the context, and this is so important. Q2 of last year included a huge one-time gain of $32.5 million from selling a vessel. If you take that out of the equation, this year's performance from their actual operations looks much, much stronger. The Q&A session gave us even more to go on. Management explained that they went for brand new ships because the market for used ones is just too expensive right now. It's a seller's market. They also sounded really confident about another healthy dividend coming this November. And, they even shared that they're disappointed with the stock's price and floated a long-term idea to maybe spin off part of their fleet to unlock more value for shareholders. So let's put it all together. Why the drop? Well, it looks like it wasn't just one thing. It was probably a mix of investors taking profits, the broader market was hitting records that day, and a quick surface-level glance at that year-over-year revenue number, which, as we just saw, was misleading. The actual fundamentals of the quarter were really pretty solid. So with all that in mind, where do we think the stock is headed from here? It's time for the next call. Based on everything we just broke down, here's our take on TEN. We are officially giving TEN an outperform rating. That massive $3.7 billion backlog of contracted revenue is like a defensive moat around the company. It gives them a level of predictability that most of their peers in the volatile tanker space just don't have. The strategy makes sense, and they're executing on it.
Okay, so if we're reading an outperform, how might someone actually structure a trade around that idea? What's the plausible pitch? The idea is a classic pairs trade. You go long on TEN stock, and at the same time you short a broad tanker index ETF. The logic is simple. You're betting that TEN's specific advantage, that huge contracted revenue stream, will protect it from the wild swings in spot rates that are going to hit the rest of the sector. It's a way to isolate what makes TEN special and bet on that. And there are a few things coming up that you'll want to keep on your radar. The Q3 report is going to get a nice little boost from a $9 million vessel sale. Their new tanker, the Silia T, starts its charter on October 1st. Then we have the next dividend announcement in November, and of course, any news on them locking in contracts for those new supertankers would be a big positive. And finally, as always, we've got to say it. Remember to do your own research and make your own decisions. This is not financial advice.